Welcome to the Great Divergence. We're going to decode the global economy for 2026, because right now we are getting two completely different signals. On the one hand, a story of solid growth. On the other, a story of fracture and fear.
So that's the big question, right? Is everything fine, or is it all about to break? Because global growth is fracturing. The European Central Bank just slashed its growth forecast to almost nothing, while at the same time, major investment banks are still calling for a bull market. The data they cannot hide tells two different stories.
And here's that conflict in black and white. You've got the official story, the consensus view from a giant like Goldman Sachs, penciling in a pretty healthy 2.8% global growth. But then you see the cracks. The European Central Bank is looking at the euro area and seeing just 0.9% growth. That's not a gap, my friends. That is a chasm.
So let's start with the optimistic take. Let's look at the baseline case for why so many people think the world economy is actually pretty resilient. When you look at the numbers from Goldman, you can see why they're optimistic. It's not just one region. It's pretty broad, a solid 2.8% for the globe. China, despite all the headlines, is still expected to post a strong 4.8%. The US, it just keeps outperforming everyone's expectations. Even the UK is seen growing at 1.4%. On paper, this looks like a pretty sturdy global engine.
And, that kind of economic strength is supposed to translate directly into the stock market. The logic is simple, right? Economies grow, companies make more money, and stock prices go up. Goldman Sachs is actually calling for a broadening bull market, which signals a lot of confidence from investors.
Okay, so that's the rosy picture. That's the baseline forecast. But here's the thing. It's happening in a world that is getting more unstable by the day. So now we have to pivot to the powerful counter-narrative, the geopolitical tremors that are shaking the very foundation of that optimism.
Every year, the Eurasia group puts out its list of the biggest threats to the world. And their 2026 list, it's a real wake-up call. We're not talking about small problems here. They're pointing to a high-velocity reordering of the international system. Number one on the list, a U.S. political revolution, followed by a Europe under siege and major structural issues in both Russia and China.
I mean, just let that sink in. The United States, the country that has basically been the anchor of the global system for decades, is now being called its single greatest source of risk. Why? Eurasia Group says it's because of an attempt to systematically dismantle the checks on executive power, which is changing the whole U.S. political system as we know it.
And this shift even has a name in foreign policy circles, the Donroe Doctrine. You can think of it as a reboot of the old 19th century Monroe Doctrine. It's all about reasserting U.S. dominance in its own backyard, mostly to push back against China's growing influence. It's a huge strategic pivot inward and has massive consequences for global trade.
Now, this instability isn't just an abstract political idea. Let's zoom in on Europe, which Eurasia Group literally describes as being under siege. This is where you can really see how these geopolitical tremors are causing economic earthquakes. Those cracks we talked about, here they're becoming a full-blown stagflation trap.
And there's that number again, 0.9%. The European Central Bank had no choice but to slash its growth forecast for 2026. And they're pointing the finger directly at global conflicts messing with commodity markets, which is just crushing people's incomes and business confidence.
So growth is falling off a cliff. But at the exact same time, the ECB had to revise its inflation forecast upwards to 2.6% thanks to energy prices. So let's see, low growth and high inflation. Yep, that is the textbook definition of stagflation, and it is a central banker's absolute worst nightmare.
And this chart from the ECB itself just lays it all out. You can see inflation is still stubbornly stuck above their 2% target. And look at what's driving it, energy and services. These price pressures just aren't going away. Now, if you want to navigate this 2026 stagflation trap before the big institutional money rotates, this is probably a good time to hit that subscribe button.
With Europe stuck in this trap and geopolitics getting rockier, it is no surprise that investors and even central banks are scrambling for safety. And that brings us to the market's verdict on all this chaos, a massive gold rush that exposes some really deep structural fears about where we're headed.
Just look at this number. JP Morgan thinks gold is going to $6,300 an ounce by the end of 2026. This isn't just a slightly bullish call. This is a forecast that screams that major institutions are deeply worried about the stability of the entire global system. This is the ultimate central bank fear playing out.
So what's behind this? It's really a perfect storm. You've got central banks buying gold at a historic clip. They're trying to de-dollarize and not be so reliant on one currency. Then you have the Fed, which is expected to cut rates, making gold look even more attractive. But the real kicker, it's a fundamental fear about sovereign debt and the long-term value of our paper money.
And let's just put that JP Morgan target into perspective. With gold around $4,867 today, a move to $6,300 is a massive vote of no confidence in the way things are. Analysts are saying this isn't just some short-term blip, it's a structural reevaluation of risk across the board.
Okay, so how do we make sense of all this? We've got this story of sturdy growth and bull markets on one side, and a story of geopolitical fear, stagflation, and a gold rush on the other. Well, the key is to stop trying to pick one. We need to understand that we are now living in an era of fragmentation.
And this slide perfectly captures what fragmentation looks like. Check this out. On the left, you have JP Morgan saying, buy European industrials. They're going to benefit from AI and German stimulus. On the right, you have Eurasia Group saying, no way, they're going to get destroyed by China's export machine and the Europe under siege risk. They are looking at the exact same thing and seeing complete opposites.
And that really is the main takeaway here. 2026 is not a simple story. It's not a choice between boom or bust. It's an era where both can be true at the same time. The US can outperform while Europe stagnates. Tech can soar while central banks hoard ancient metal. The world isn't moving in lockstep anymore. And just a reminder, this analysis is for educational purposes, based on institutional data. It is not financial advice. Always execute your own risk management.
So this leaves us with one final crucial question. In a world this fragmented, is the biggest risk we all face just choosing to believe one simple story? It seems the ultimate hedge isn't just accumulating gold. It might be aggressively shorting European industrial ETFs. To learn more, watch our previous intelligence briefing on the 2026 commodity supercycle to restructure your portfolio. Click the video on your screen now.